In August of 1973, two men sat in separate offices in the United States, each looking at a ledger that showed exactly $1,000 in liquid capital. The first man was Robert Hughes, a 40 high school administrator in Ohio. Robert was the picture of the post-war American dream. He was careful, he was disciplined, and he trusted the system. He had spent the last 15 years saving his surplus income, placing it into a mix of high-yield savings accounts and long-term government bonds. His money was earning a steady 5%. To Robert, this was the definition of security. He had followed every rule he was taught. He had delayed gratification. He had built a safety net for his family's future. The second man was Thomas Vance, a partner at a private investment firm in New York. Thomas looked at the exact same $45,000, but he saw a landscape of hidden risks. He did not trust the nominal number in his bank account. He understood that the underlying currency was being stretched to its breaking point. So, Thomas did something that, to the average person at the time, looked like absolute financial insanity. He liquidated his cash position entirely. He used the $45,000 to purchase physical gold, bullion at roughly $6 an ounce. And he took a leveraged position in a basket of industrial commodities. Both men started with the exact same capital. Both men were operating in the exact same macroeconomic environment. Fast forward exactly 7 years to December 1980. Robert Hughes opened his bank statements. His $45,000, thanks to the magic of compound interest on his bonds and savings, had nominally grown to roughly $78,000. He should have been thrilled. But when he walked into a dealership to buy a new car or looked at the price of a modest home upgrade, a cold realization washed over him. The purchasing power of his $78,000 was significantly less than the purchasing power of his original $40,000 in 1973. Cumulative inflation had erased over 40% of his real wealth. His safe money had been silently hollowed out. He would have to work until he was 75 just to maintain his standard of living. Thomas Vance, on the other hand, looked at his portfolio. The price of gold, which he bought at $65 an ounce, had just peaked at $850 an ounce in January of 1980. His initial $45,000 had multiplied more than tenfold. He was now sitting on over $500,000 in purchasing power. He never had to work another day in his life. Same starting capital, same time frame, same country. One man was financially destroyed. The other was immortalized. Though some pattern interruption, what happened here was not random. It was not a matter of bad luck. And Robert Hughes did not make a foolish mistake by any conventional metric. He did exactly what financial advisors, banks, and the government told him to do. He saved his money in the safest assets on earth: U.S. government debt and insured bank deposits. The tragedy of Robert Hughes is the tragedy of the modern middle class. It is the realization that the rules of wealth preservation are an illusion. What most people miss when they look at the 1970s is that the destruction of middle-class savings was not a bug in the economic system. It was a feature. The system required the destruction of the patient saver to pay for the fiscal scenes of the state. The wealth did not simply vanish into thin air. It was transferred. It was moved from the accounts of the prudent to the portfolios of the positioned. To understand how this happens, and more importantly, to understand how it is happening right now, we have to stop looking at the economy as a collection of random events. We have to look at it as a machine. And once you see the gears turning, you can never unsee them. Tres, introduce mechanism. I call this mechanism the currency depreciation siphon. It is vital to understand the terminology here. The mainstream narrative will tell you that during the 1970s, the price of goods and assets went up. They call this inflation. But that is a fundamental misdiagnosis of the physics of money. Goods did not become more valuable. The currency became less valuable. The currency depreciation siphon is not an inflation mechanism. It is a transfer mechanism. It is a structural process by which a failing fiat currency system extracts purchasing power from the bottom and the middle of the economic pyramid and funnels it to the top. It moves wealth from the patient creditor to the leveraged debtor. It moves wealth from the wage earner to the asset owner. The siphon operates quietly. It does not announce itself with a stock market crash or a banking panic. It operates in the background, eroding the denominator, the value of the dollar. While the nominal numbers on your screen stay exactly the same, it creates the illusion of stability while executing a massive, silent confiscation of wealth. 4. Break down into steps, phases. Asterisk. The currency depreciation siphon does not happen overnight. It is a deliberate, multi-phase process. To understand the 1973 gold shock, we must break this mechanism down into its 4 distinct phases. Phase 1. The anchor and the illusion. For the first phase to work, the public must believe that money is a permanent store of value. Following World War II, the Bretton Woods Agreement established this illusion. The US dollar was pegged to gold at exactly $35 an ounce, and the rest of the world's currencies were pegged to the dollar. For 30 years, the American middle class lived under this anchor. Because the dollar was supposedly backed by physical gold, people believed their savings accounts were immune to depreciation. Human psychology relies on the nominal number staying the same. If you have $100 in the bank, it says $100. The anchor creates a false sense of permanence, encouraging the middle class to hoard cash and buy long-term bonds, completely unaware that they are holding a melting ice cube. Phase 2. The fiscal rupture. The siphon is activated when the government spending exceeds its ability to tax, and the anchor prevents them from printing money to cover the difference. In the 1960s, the United States embarked on 2 massive, unfunded endeavors: the Vietnam War and Lyndon B. Johnson's Great Society programs. This was the classic guns and butter deficit. To pay for this, the U.S. began printing dollars far in excess of its gold reserves. The anchor chain began to stretch. Foreign nations, particularly France, noticed this discrepancy and began demanding physical gold in exchange for their dollars. The U.S. gold reserves at Fort Knox began to drain. The system was mathematically breaking, but the public could not see it yet. Phase 3. The severing and the shock. This is where the mechanism becomes violent. In 1971, President Nixon temporarily closed the gold window, stopping foreign nations from exchanging dollars for gold. But the true rupture, the event that triggered the massive wealth transfer, happened in 1973. The attempt to maintain a fixed exchange rate failed completely. The dollar was allowed to float. Simultaneously, the OPEC oil embargo was enacted, quadrupling the price of energy. This created a dual shock, a collapsing currency and a skyrocketing cost of basic shunswen. Because the dollar was no longer anchored, its value was now determined purely by supply and demand, and the supply was expanding rapidly. The price of gold, which had been artificially suppressed at $35, was suddenly allowed to find its true market price. It surged from $65 in 1973 to nearly $200 by the end of 1974. The severing was complete. Phase 4. The siphon in motion. Once the currency is allowed to float downward, the siphon activates as the value of the dollar collapses. The nominal price of hard assets, real estate, commodities, and equities. But here is the critical mechanical detail. The middle class is heavily exposed to fixed income assets. They hold savings accounts, certificates of deposit, and pensions. Their returns are fixed in nominal terms. As inflation surges, the real value of those fixed returns turns negative. The middle class absorbs the loss. Meanwhile, the top 1% holds hard assets and fixed-rate debt. If you owe the bank $1 million, at a fixed 5% interest rate, and inflation runs at 12%. The real value of your debt is being wiped out. The debtor wins. The creditor loses. The siphon has successfully transferred the wealth. Cinco, historical proof. It is easy to look at the 1970s and dismiss it as a unique anomaly, a perfect storm of oil embargoes and geopolitical chaos. But the data shows that the currency depreciation siphon is not an anomaly. It is a recurring historical pattern. Whenever a fiat currency system reaches its debt limit, this exact mechanism is deployed. Let us look at the historical proof. Consider the year 1933. The United States was in the depths of the Great Depression. The public, terrified of bank failures, had hoarded physical gold. The government needed to expand the money supply to stimulate the economy, but they were constrained by the gold standard. The solution was explicit and brutal. President Roosevelt issued Executive Order 6102, making it illegal for citizens to own monetary gold. The public was forced to turn in their gold at $20.67 an ounce. Once the government had confiscated the physical metal, they immediately revalued the price of gold to $35 an ounce. This was a deliberate 40% devaluation of the dollar. The wealth transfer was not hidden. It was written into law. The middle class lost their physical wealth, and the government instantly inflated its balance sheet. The siphon operated in plain sight. Now, fast forward to the great financial crisis of 2008. The mechanics were different, but the outcome was identical. When the housing bubble burst, the middle class lost their primary asset, their homes. Millions were foreclosed upon, wiping out decades of generational equity to prevent a total systemic collapse. The Federal Reserve initiated quantitative easing, printing over $1.7 trillion in the first year alone. What happened next is a masterclass in the siphon. The newly created money did not flow into the real economy to boost wages. It flowed into the financial system, bidding up the price of equities and real estate. The S&P 500 tripled over the next decade. The top 1%, who owned the vast majority of financial assets, saw their net worth explode. The middle class, who were trying to save cash in a zero-interest rate environment, watched their purchasing power stagnate, while the cost of housing, healthcare, and education outpaced their wage growth. Same crisis. Different outcome for the top and the bottom. Finally, look at the events of 2020. The pandemic response triggered the most aggressive fiscal and monetary expansion in peacetime history. Over $5 trillion in fiscal stimulus was deployed, and the M2 money supply expanded by 40% in just 2 years. The currency depreciation siphon operated at maximum velocity. Asset prices went parabolic. The stock market, real estate, and even speculative digital assets experienced massive nominal gains. The top 1%, already positioned in these assets, absorbed the vast majority of the newly created wealth. Meanwhile, the middle class, holding cash in bank accounts yielding 0.1%, faced an official consumer price index that hit 9%. With real-world inflation in essential goods running much higher, the data shows a massive divergence. Asset prices detached from economic reality, and the purchasing power of the wage earner was systematically siphoned away to fund the asset inflation of the capital owner. This always happens. The asset class changes, the geopolitical trigger changes, but the mechanical transfer of wealth from the saver to the asset holder remains a constant law of financial physics. Says and return to present. Right now, we are in the late stages of a remarkably similar cycle. The United States is currently carrying over $35 trillion in national debt. The interest expense on that debt has surpassed $1 trillion annually. Mathematically, there is no way to pay this debt back in real terms. The economy does not grow fast enough, and the tax base is not large enough. This is where it gets important. When a system reaches this level of debt saturation, it has only two choices. It can default, which would destroy the global financial system, or it can monetize the debt, which means printing money to pay the interest. History dictates that it will always choose to monetize. We are currently entering a phase of what economists call financial repression. This is the modern, sanitized version of the currency depreciation siphon. The goal of financial repression is to keep interest rates artificially below the rate of inflation. If the government owes $35 trillion and inflation runs at 4 or 5%, while interest rates are capped or managed, the real value of the debt is quietly erased. But who pays for that erasure? The bondholders, the savers, the pension funds, the middle class. The siphon is currently operating in the background. You do not see it because the nominal numbers in your bank account are still going up. Your employer gives you a 3% raise. Your bank gives you a 4% yield on your savings. It feels like progress. But if the real inflation of the currency is 6%, you are experiencing a negative real yield. You are losing purchasing power every single day. And that purchasing power is being transferred to the issuers of debt and the owners of hard assets. The system is working exactly as it is designed to work. Siete Signas. To watch. You do not need to be a macroeconomic genius to see the siphon in action. You just need to know where to look. There are 3 measurable indicators that show the mechanism is active. The first signal is real yields. This is the nominal interest rate minus the rate of inflation. For decades, real yields were positive, meaning savers were rewarded for their patience. When real yields turn deeply negative, it is a mathematical confirmation that the siphon is active. The system is explicitly penalizing the saver and subsidizing the borrower. If you track the 10-year Treasury yield minus the you will see the exact rate at which your purchasing power is being extracted. The second signal is central bank gold accumulation. The ultimate insiders are the central banks themselves. For the last 2 decades, central banks were net sellers of gold. But since 2022, the narrative has completely reversed. Global central banks purchased over 1,000 tons of gold in 2022 and another massive amount in 2023 and 2024. They are not buying gold because they think the price will go up. They are buying gold because they are front-running the currency depreciation siphon. They know that the fiat system is fracturing, and they are moving their reserves into the only asset that cannot be printed by a rival nation. When the issuers of the currency are hoarding the ultimate hard asset, the signal is unambiguous. The third signal is the divergence between asset prices and median wages. Track the S&P 500 or the case home price index against the median household income. Historically, these metrics move somewhat in tandem. Over the last 15 years, they have completely detached. Asset prices have gone vertical, while median wages have grown in a slow, linear crawl. This divergence is the visual representation of the siphon. It shows exactly where the newly created money is going. It is not going to the worker. It is going to the asset. ****. Return to original story. ****. Let us return to Robert Hughes and Thomas Vance in December of 1980. Robert sat at his kitchen table in Ohio, looking at his final tax documents and his bank statements. The nominal numbers looked fine. He had more dollars than he started with. But when he calculated the real cost of living, the math was devastating. His $45,000 of 1973 purchasing power had been reduced to the equivalent of $26,000 in 1980. The safe government bonds he had relied on had betrayed him. The inflation tax had taken nearly half of his life's work. He realized, with a quiet, sinking feeling, that he could not afford to retire at 60. He would have to keep teaching until his physical health gave out. He had played by the rules, and the rules had been changed while he was playing. Thomas Vance sat in his office in New York. He had already taken his massive profits from the gold trade and quietly rotated them into prime Manhattan real estate and a diversified portfolio of dividends-paying equities. He had used the exact same mechanism that destroyed Robert's wealth to build his own empire. He understood that the dollar was a melting ice cube, so he had built a fortress out of things that could not be melted. He was 45 years old, entirely financially free, and completely insulated from the economic chaos that was ravaging the middle class. The tragedy of this story is not that Thomas Vance got rich. Wealth creation is a natural part of a functioning society. The tragedy is that Robert Hughes was penalized for his prudence. The system required a victim to absorb the cost of the currency, and Robert, with his savings accounts and his government bonds, was the perfect, willing victim. 9. And final message. The lesson of the 1973 gold shock is not a lesson about how to pick the right stocks or how to time the market. It is a fundamental lesson about the architecture of the financial system. Money, in its modern fiat form, is not a store of value. It is a mechanism of debt. It is a tool designed to facilitate the transfer of resources from those who produce and save to those who borrow and spend. The currency depreciation siphon is not a glitch in this system. It is the primary function of it. When you understand this, your entire perspective on wealth changes. You stop looking at the nominal numbers on your screen and start looking at the real purchasing power in your hands. You stop asking what the market will do tomorrow and start asking what the currency will be worth in 10 years. The data shows the pattern. History shows the outcome. The only variable left is whether you choose to be the victim of the siphon or whether you choose to position yourself on the other side of the mechanism. If this gave you a new framework for understanding the hidden architecture of wealth and currency, consider sharing it with someone who needs to see the machine for what it really is. The system relies on our ignorance. Understanding the pattern is the first step to protecting your future.